iconic movie Dil Chahta Hai just completed 20 years. And I'm sure everybody remembers the road trip from Mumbai to Goa, where the three friends travel in a Mercedes car with amazing music and an amazing song on the background. And it motivates all of us to have a road trip, only to realize that actually the trip is for 24 hours and how difficult or how painful that journey is. And then you have to also come back 24 hours. Now, what I'm trying to say from an investment perspective, because investments talk about the long-term picture. Unfortunately, we are never able to understand the pain and the problems which happen on a daily basis. So yes, all of us know it's not a secret that Sensex started back in 1979 with an index level of 100. As we speak right now, it's around 56,000 plus. That means a 1 lakh rupee invested would have become 5.6 crore rupees. That's the amount of wealth which got created. And I'm not even including dividends. If you include dividends, it's a crazy number. So equity has the potential to create wealth. But if you look at the number of retail investors who have enjoyed or created this wealth, you can hardly count. In fact, majority of the investors many a times lose wealth. And let's try to understand, let's try to zoom out to figure out what happens in the entire journey so that we can learn from the mistakes of the past so that we don't make the same mistakes and create wealth for ourselves and for our families. First and the foremost thing, which is given when you're investing into equity market, which is called as volatility. A lot of investors don't understand what is volatility. Let me try to explain it in very simple terms. Markets always go up and down. Going up makes us feel happy, forget about that. But going down always hurts us. If you look back at history, a 10% fall in equity market is very normal. It practically happens every year. So a 10% fall is like, it's given. If you're investing in equity market, experiencing a 10% fall is something which you have to be anytime prepared for. Leave 10%, even a 20% fall happens very frequently. So if you're an equity investor, losing 20% of your capital is something which you should be, at any given time, should be mentally prepared. If you look back at data of 40-50 years, you also realize 30% fall also happens once in 3-4 years. So not in a linear fashion, but yes, a 30% fall is also quite common. And once in a while, like maybe once in a decade, you can also expect a 50% fall, which has happened in the past. In fact, many times, if you look at the past, once in a decade, at least market corrects 50%. The last what we had experienced was in 2008 global financial crisis. Nifty corrected by more than 50%. Now, this is the nature of equity market. Markets always corrected. They have corrected in the past. They will correct in the future. Second point is, the journey of equity market is not a fixed line. FDs move like a fixed line. The journey of equity market doesn't move like a fixed line. There are periods when equity moves like Ferrari, and there are periods when equity market moves like bullock carts. Let me talk about the periods when equity market has actually moved like bullock carts, or I would say like a traffic jam when nothing moved for years. 1992 to almost 2003, for 11-12 years, equity market practically gave no returns. Nifty gave no returns. 2008 peak to 2014, for almost 6 years, Nifty gave no returns. These are boring periods which test patience of even the investors who have been pros in markets. Even it tests patience of those kind of investors. And we all know by nature human beings are very impatient. When we don't make returns, live about years, even for months or even for days, we get so impatient. So test your patience. Third is, there is always something happening somewhere. I'm very sure a lot of investors, in fact majority of the investors say, you know what, there is so much happening in the world. Do you think it's the right time to invest? And my question is very simple. Tell me a period where world or in general things were very safe. There is always something happening somewhere. Let's rewind back in the last 41 years. The biggest risk for any country is losing their prime ministers or their biggest leaders. We saw two of our biggest, strongest prime ministers got assassinated. We saw Indira Gandhi and Rajiv Gandhi got assassinated. We had a 1991 economic crisis where we didn't have sufficient dollars to actually manage few days of our imports. We also had scams which took place, a Harshad Mehta scam or a Ketan Parekh scam. We saw global financial crisis in 2008. We saw a dot-com bubble which took place over there. Now we are facing a pandemic. We also saw big corporate scams and big companies failing in the entire journey. There is always something happening somewhere. There are elections, there are budgets, there is global noise, there is global economic tensions, there is US-China problems, there are problems with neighbors. There is always something happening somewhere. This is how the world is designed. There are more than 200 countries. There's so many different interests. Economies move in cycles. There is always something happening somewhere. But the interesting point is, equity in the long term always creates wealth. Now, if I have to sum basically what I'm trying to say, it's no secret that equity will create wealth. It has created in the past, and most likely it will always also create in the future. The question is, will you create wealth? Now, when I talk about equity wealth creation, a lot of people think opening a demat account and buying stock is called equity, and the answer is no. Equity is not about getting up in the morning and looking at your screen and looking at prices. Equity basically means investing into businesses. So when you invest into stocks, do your research, understand the company, understand the management, understand the valuation, understand the economic cycle, understand the cash flows and everything about the company. And you will say, no, I don't have the time, energy and knowledge. And this is what is so important. You have to keep your ego aside. Once you acknowledge that you don't have the time, energy and knowledge to do all that stuff, outsource it to a mutual fund. Now you can either choose an actively managed mutual fund, or you can just choose a simple passive fund like a Nifty or a Sensex or a Next 50, or maybe have a combination of active funds and passive funds. Outsource it. That's the most logical way, and that's keeping ego aside. That I don't understand what's happening. There are smart people, smart fund managers who can manage the money. Let me give it to the experts. So I'll just sum up what I'm trying to say. First, equity market was volatile, is volatile, and will always be volatile. The world was uncertain, is uncertain, and always will be uncertain. Businesses always create wealth from a long-term perspective. Not all businesses create wealth. That's why diversification is very important. Outsourcing it to a mutual fund is the best option for majority of us. Also understanding that market volatility, a 10, 15, 20% fall is very normal, and mentally you should also be prepared for a 30 to 50% fall. If you're able to do this, and if you're able to have long time horizons, you are most likely to succeed and create wealth. I hope some anxiety and nervousness about equity has come down. Happy investing, stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.